Hello, my name is Marcus Walker, and today I'm going to be talking a little bit about a tenant in common, or a TIC, with its acronym. So basically, what exactly brought me to do a presentation about this topic? So basically, this year I've been working at Apple Growth Partners for the second time, and I will be working there full-time after graduation. But this time, as a part-time intern, I've been working on tenant in commons through tax scheduling, and it's very interesting to see because I didn't learn in college or in high school what a tenant in common was. And now that I'm working on it, it's cool to see how they work, and when I'm working on them, I can see the little differences between a normal partnership filing or an S-corp filing. I can see the differences between those two and the tenant in common. So what exactly is a tenant in common? So a tenant in common is basically where two parties share ownership rights in a parcel of land, which when it comes down to a legal arrangement. So it's very simple. Basically, two companies share a parcel of land. They can build whatever building they want on it. They have their own depreciation schedules based on their building and equipment, but everything else is split evenly or by whatever allocation percentage it is. It could be 50-50, like I said, or it could be 70-30. It could be whatever percent allocation it is based on the companies. So what are the differences with preparing a TIC? So with a TIC, you do not need to file a return unless it is a partnership declared in their company. Like I said also before, revenues, expenses, and other balance sheet items need to be split with whatever percent allocation it is. Now, with some exceptions with amortization and depreciation, those are not split unless it is directly stated. If the company has their own building on a parcel of land and then the other company has a different building on that parcel of land, then that depreciation is split based on whatever it is, based on their makers or straight line or whatever depreciation they are going about. Next, a TIC split can have two of the plus businesses be a partnership. Therefore, if one of the businesses is a partnership, they would need to file a 1065, or if they were an S-corp, they would need to file a 1120S. So it's very interesting to see the differences between just a normal TIC and a TIC split that has a company that is a partnership, because it's very different how you file. One doesn't need a return to be filed, but one does. So it's very cool to see. Like I said a little bit before, some examples of tenancy in common. So if you look on the left side here of the photo by Quicken Loans, you can see an even distribution, 25% all four ways between person A, B, C, and D. And then if you look on the right side, you can see it is an odd distribution of tenancy in common with unequal shares. So you got person A with 15%, person B with 30, C with 35, and finally D with 20. It can be split in various different ways. I have yet to see one that has a tenancy with 4 different partners. The most I've seen is 3, but it's the same concept here. It can be split in 2 different ways. It can be split evenly, or it can be split with odd or unequal shares. So, and that is how you would allocate the revenues and expenses based on those percentages. So if for on the left side, if you had $100,000 of rental income, it'd be split by 25%. So then they would have $25,000 each rental income, and then it would be based on the percentages on the right side. If person A would get $15,000, simple math, right? So how can a TIC be ended? So if at the end of the day the two companies don't really get along, one company can buy the remaining shares of the other company, and then they would own that entire TIC, and then they could start filing under a partnership, or they can stay as a TIC and they wouldn't need to file a 1065 or a 1120S. Also, it can be ended with a partition suit. So a partition suit is basically when the two companies in the TIC, or 2 or 3, do not agree on the future of the TIC at all, and they would need to go take legal action against one another, and then the court will decide on where the future is going, and then it could be ended that way. It's very interesting to see how that can change, right? So hopefully no TICs, and on that reason, hopefully one company just needs to get out of there, and the other company buys the remaining shares. Finally, I'm just going to talk a little bit about my experience with TIC, since I've been working on it a little bit, like I said before. It's very cool to see, because when I was working as a full-time intern last year, I was strictly working on 1099s or 1040s, very basic returns, but now since this is my second year, and although it is just a part-time, I'm learning how to work on 1065s, 1120Ss, and then finally TICs. So it's really cool to see the step up between simple 1099s or 1040s, and then now we're working on 1065s, 1120Ss, and TICs. So let me talk a little bit about my experience with TICs as of right now. So this is a little bit about the process that I go through on a day-to-day basis, whether it's a TIC or not, at least with assigning to me. So I go through tax ledger, we have a meeting every day on Monday, and I see what is assigned to me for the week and weeks ahead, right? So for the past, I want to say like 2 to 3, maybe even 4 weeks, I've been assigned TICs on a very regular basis. In fact, one week, I strictly just worked on TICs. Throughout spring break, I was just working on TICs. It was very cool to see where I was just solely working on it and learning how they exactly work. When I get assigned a TIC, I go into their binder and I compare the PDF supporting documents, which include their trial balance, their general ledger, whatever cash reconciliation there is, legal fees, whatever, and any other fees or revenues that are included in their PDF docs. I make sure that those docs resemble what is exactly on their client TB, because if it's not, then something is wrong or a wire. And then after that, we prepare the TB and make our own adjusting entry. So I basically import their client TB into our system, and if there's any adjusting entries that are needed, whether it be M1 adjusting entries or grossing up loan fees, which is 2 of the things that I've seen on a regular basis, we make those. They do not make those, we make those, so then it can be shown in the return consistently throughout the years. And if there is a TIC split needed, basically you prepare the main company TIC, and then you take the revenues and expenses from that TIC, and if there's 2 companies within that tenancy in common, you split it based on whatever allocation it is, whether it be 50-50, 70-30, whatever the case is. You prepare the TIC split for the other company so then they can get their revenues or expenses. And like I said before, if one of those TIC split companies is a partnership, they would need to file a 1065 return. Like I just said, if a company is a partnership, a 1065 is needed for filing. Like I said multiple times, it's very important because if they miss a window for a 1065, it's very problematic. They will go through a penalty if they do not file. If not, the job is done and it is sent to the reviewers. So once you get done with the TIC split in Excel, you ship it off you make sure all the documents are good, the working trial balance is A-OK. Then once the job is done, you send it off to the reviewer, right? So that doesn't necessarily mean that my job is done. There have been a couple times where there has been the potential for it to be sent back to me, and I need to revise some of the things that I did not do, or I did, and it just doesn't need to happen. I've had a couple of things sent back to me, and it happens sometimes, right? So it's very interesting to see the process. That also isn't just for TICs, it's for 1065s, 1120Ss, 1040s, whatever the case may be, right? And then finally, I just want to leave off with a little example of 2 companies that I have worked on a little bit with the TIC split, and it's very interesting to see. So KJR Wooster is actually the main company here. So they have their own, they are a partnership, and these guys are also a partnership, but they are in tenancy in common. So KJR Wooster has all of their income coming to them, but then what they do is they send off a K1 to JJP Wooster, and that income is investment income from KJR Wooster, and it's very cool to see how some of the income is dispersed between 2 of the companies. Very interesting dichotomy. I just want to leave off with my references here. I hope you guys learned a little bit from my presentation today. Have a good one. Thank you so much.